Will the recession make the Fed look like a bunch of turkeys? That's our burning question today. Welcome to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Excited to have you with me this Thanksgiving week. And boy, oh boy, do we have a lot to cover in today's episode. Had a myriad of information last week that is market moving. And then although we've only got 3 days this week before Thanksgiving, we've got quite a bit of information to cover for this week as well. So let's dive headfirst into the stuffing of these details. All right, so let's get to the week in review. So last week we had an incredibly large amount of economic and real estate data come out. For starters, we had retail sales come out, and this measures sales on retail and service industry across the country. And this came in at $694.5 billion for the month of October. This was up 1.3% month over month. And boy, does that signal that consumers are resilient in the face of a recession. Now, where is that coming? Where's that spending coming from? The data came out a couple weeks ago that we're seeing a significant increase in consumer credit card balances, things like that. So we're probably seeing more living, I hate to say living beyond the means of the average consumer, but the average consumer is forced to put a lot more of their day-to-day, week-to-week, month-to-month spending on credit based on the prices of everything going up from inflation. So retail sales looking resilient, which would normally be an indicator of strength, but we've got to look a little bit deeper and see where that spend is really being put. Next, we got the NAHB Housing Index. This is the National Association of Home Builders Housing Index, and this is a survey that allows us to gauge builders' optimism about current building conditions and expected build projects going forward. And so this is a scale of 0 to 100. Anything above 50 signals optimism from the national home builders, and then anything below 50 is looking at contraction or pessimism on the building front. Now, last month's reading, we got a 38 on that scale. The expectation going in by market analysts was 36 for this month's reading, came in at 33. So came in below expectations. Builders not looking so optimistic about where the industry is heading going into the start of next year. Now, a lot of that probably has to do with an impending recession. During a recession, activity slows down. Good news, interest rates decline as well. But if activity slows down, home buying slows down, then you can expect that builders are going to need to and have to slow down on the pace of their builds and the sales activity. So that's what we're seeing indicated in this survey. We also got building permits and housing starts. And so building permits is permits pulled on new construction projects. And this isn't specific to single family residents, but it does give us an idea of the construction industry, how the economy is reacting to the current economic environment. When building permits are up, that means we've got a lot of growth. We've got construction, new buildings going up, new homes going up, and that creates jobs, among other things. So it indicates a lot of economic activity and potential growth. Building permits came in at 1.526 million on an annualized pace. Now, this was actually up from analyst expectations of 1.512 million, but we are seeing a slowdown month over month. The previous month came in at 1.564 million. So we did decline by about 40,000 permits pulled. So this is something that we're going to keep an eye on as we go forward into the rest of the fourth quarter in the beginning of 2023, which is when a lot of analysts are expecting to officially call us in a recession. Now, again, we got housing starts and also on an annualized pace. So that came in at 1.425 million versus an expectation of 1.41 million. So again, like building permits, we beat estimates, which is definitely a good sign for the construction industry. However, we are seeing that slow down from the previous reading, which was 1.488 million. So a pretty sizable 60,000 new start decline from the previous month. Now, you could chalk it up to the time of year. This time of year, construction and housing does tend to slow down a little bit. So we want to watch that going forward as we head into the spring of 2023 to see if that picks up and we start to rebound or if it continues to decline. As always, last Thursday, we got jobless claims, and this is unemployment claims. And this is broken into two categories. Number one is going to be initial unemployment claims, which is anyone filing for unemployment for the first time. And then we also got continuing claims, which is individuals renewing their unemployment benefits. So this is a week over week reading. Initial claims, we got 222,000 new unemployment claims. Now this was slightly less than the expectation of 225,000 and a little bit less than last week's reading of 226,000. So we've recently elevated the unemployment filings to the 220,000s, up from the 180,000s to the low 200s. We're slightly creeping back up. As always, something we want to watch for trending purposes. Now, on the continuing claims side, this one was a pretty significant. Pretty significant change, or at least a notable change. We came in at 1.507 million renewing claims. This was a little bit higher than expectations, which was a flat 1.5 million, and this was up from the 1.494 million from the prior week. And so what this tells us about the economic and labor markets is it indicates that we are seeing employers let employees go. We're seeing reports in the news about large companies laying off employees, but the continuing claims tells us that we are starting to see job openings and hiring slow down. And that means that employers are likely, they're letting some of their employees go, but they're also retaining some of their employees longer versus going out and hiring more employees. And I think we've all watched enough news and media and seen online that's definitely what we're seeing in the economy from a lot of your large cap or your larger companies. Now, if that wasn't enough, we also got existing home sales. Now, this is an important number or an important category because existing home sales makes up 90% of our housing market on an annual basis. So on an annualized pace, we saw a 4.43 million existing home sales. Again, this is an annualized pace, but this was down 5.9% month over month from the previous reading of 4.71 million. Now, we also missed expectations we also beat expectations. Market analysts expected 4.28 million. So the housing market also showing its resiliency in the face of an impending recession. And so that's good news if you're a real estate agent. That's great news if you're a homeowner. And that's also positive news if you're a home buyer, because you can go into this market with confidence, despite some of the challenges that we're seeing in the real estate market. So one other note on existing home sales. Existing home sales did peak recently in January. And so the most recent October numbers are down about 32% from January's peak. So we have slowed down throughout the course of the year, and mortgage rates have more than doubled since the end of last year. So as you can expect, that would have an impact on the pace of sales. Some home buyers are electing to sit on the sidelines, waiting for possibly some lower rates, and that's slowed that whole process down. But still a great time to buy. Home prices have softened a little bit, and we are likely to see interest rates come down in the near future, which makes refinancing to lower that rate a great option while building equity in the meantime. Now, next week, I say next week, later this week, we've got we got a ton of information coming out on Wednesday. Wednesday is going to be a massive week. We're going to have jobless claims moved up from Thursday to Wednesday because of the Thanksgiving holiday. So on Wednesday, we're getting jobless claims. We're getting consumer sentiment, the University of Michigan's consumer sentiment, so survey looking at the consumer's outlook of the economy as we head forward. We're also getting new home sales. And then real big market mover potentially, we're getting the Fed minutes, the meeting minutes from the most recent Fed meeting. And so the speech or the talk that Jerome Powell gave after the meeting, last meeting, was definitely market moving, but the meeting minutes gives us an inside peek into really what the Fed is thinking, what the Fed is talking about, and their potential direction going forward. And I'm going to hit a little bit more on this here in just a second. So that is the data from last week and this week impacting the economy and our real estate market. Now, as always, what to keep an eye on moving forward? Well, number one right now is the health of the economy. So I talked about retail sales. This is the time of year where we see retail sales and services spike for the holidays. So we want to look at where that is on the next several reports through the holidays to see how the economy, how the consumer is spending in this holiday season leading into a recession. We also want to watch unemployment claims. We've seen a recent tick up in unemployment claims. Are we going to continue to see that trend, or are we going to see it level off as we head into 2023? Also, job creations. So each month, the Board of Labor and Statistics puts out the National Jobs Report, which tells us how many jobs are created the prior month. And so that's going to be an important report that we look at on a month-over-month basis heading into Q1 of 2023 to gauge the health of the economy. And then in a similar note, job openings. Every month, the JOLTS report, JOLTS, which is the job opening report, comes out, and it lets us know how many job openings there are across the country. And we're going to be watching this going forward, especially into the holiday season and coming out of the holiday season, because as we head into the holidays, you would imagine that a lot of companies are hiring at the retail entry-level positions as to fill spots for the retail holiday season. And then obviously a lot of those people are going to be let go after the holiday season. So we want to dig into those numbers to find out what the openings look like for more professional positions across the country. So something that we're going to be paying close attention to as we head into the end of this year, early 2023. And then the second big thing that we're watching going forward, as always right now, is inflation. Inflation has been ravaging the country, everything from gas prices to grocery prices to services, electricity, energy prices. Across the board, inflation has been a challenge. And so we saw a reduced inflation rate on the last CPI reading, Consumer Price Index inflation report. So we saw a reduced inflation reading on that last report. We've got two more reports coming up. We've got an inflation report on December 1st, which is going to be PCE. That's personal consumption expenditure. And then on December 13th, we've got the next CPI reading, again, Consumer Price Index. And these reports both come out prior to the Fed's next meeting. So are we going to continue to see a declining trend in inflation? If we do, that's going to bode well for mortgage rates trending down, and that's going to bode well for the consumer's wallet. So we want to watch out for that. And then we want to find out, how is the Fed going to react if we do continue to see a declining trend? Currently, at the December meeting, it's expected that the Fed's going to increase the Fed funds rate by 50 basis points, or 0.5%. And then in the February meeting, the Fed's expected to raise the Fed funds rate by another 25 basis points, or 0.25%. If we see a declining reading on the inflation reports, will they hold true to that expectation, or will they pivot and try and start to slow down those increases, which the market would love and mortgage rates would love as well? So these are the things that we are looking forward to and keeping an eye on to help you stay on top of the economy and the real estate market. If you're a real estate agent, use this information to have impactful conversations with your clients. If you want further details, always reach out to me at the number down here below or leave comments. That is all I've got for you today. If you are watching in the Powerhouse Facebook group, thank you so much for being part of our community. If you're checking us out on the Powerhouse YouTube channel, hit that subscribe button so that way you can get economic and real estate information in the palm of your hands. Until next week, have an incredible Thanksgiving, and thank you so much for being part of the community. Take care.